Good evening, welcome to Ekcel Academy. I guess we are good to go. I hope the audio is fine as well as the video. If at all there is any problem, please do let us know in the chat. I'll be monitoring the chat. Continuing the series of solving the question papers of both CMA as well as FM. We will be looking at CMA December 2019 question paper. This is what we were doing in the previous session. We had stopped at question number 46. Excuse me. Just give me a second. Let me just cover the mic. So let's see what exactly do we are supposed to do in this case. Okay, following information was given. Okay, we had stopped here. No, yeah, now I remember. So in this case, let's see what exactly they have given and what exactly they have asked. Following information were provided by a trading company to you. Net profit after tax is given for the year 2018-19, 18 lakhs 35,000. Then they have given various expenses, for example, depreciation written off, goodwill written off, provision made for taxation, income tax paid, interest on investment credited to P&L account, interim dividend paid, etc., etc. And finally, what is that they have asked is cash flow from operating activities would be how much. So now, before we find out the cash flow from operating activities, what we need to find out is the net profit net profit before working capital changes. So that can be started with the net profit given. So let me just write down the net profit first. Net profit after tax, which is 18 lakhs 35,000. So now what I will do is I will add all those expenses which are non-cash in nature, because in this case what is that we are supposed to do? We are supposed to find out the cash flow from operating activities. When we are looking at it, let's ignore all those items which are non-cash in nature and also something which is not related to operating activities. So they have very specifically asked cash flow from operating activities. So now what all can I add back to this? So if you look at this, here we have depreciation written off. So now depreciation, if it is written off, it's obviously a non-cash expenditure. Why should we even show it as an expense when, I mean, it is an expense but non-cash expense. So let me add back. Okay, Sonam Kumari has something to say. Sir, mera name lo. Okay, I think my Hindi is correct. I think she wants me to take a name. Okay, welcome to the live session, Sonam Kumari. Anyway, depreciation written off. So how much is the depreciation which they had written off? 1,08,000. So why are we adding back? Remember, it's a non-cash expenditure, so therefore we are adding it back. Likewise, what else is a non-cash expenditure? Goodwill written off. It's also a non-cash expenditure. There is nothing which is going out of the business when it comes to goodwill. So remember what is asked. What is asked is cash flow from operations. So therefore we are only worried about the cash items, or those items where cash is not involved, we'll just simply disregard. So goodwill written off. So how much is this? 50,000. Then provision for taxation, again a simple provision, so therefore we are not worried about such an item. So 5,50,000. Then what else is there? Income tax paid. See, one thing which you have to remember is income tax paid will be a liability initially. So last year maybe we had provided for taxation, provision for taxation would be there, which would be a current liability. Now that we have paid it, so that is something which will affect the working capital. We'll come back to that later. For now, let us concentrate on those items which do not affect the working capital and which is already considered in the net profit. So that is something which you have considered. Income tax paid later on. Then interest on investment credited to profit and loss account. Okay, here it is interest on investment which has got nothing to do with our operation. So therefore what we'll do is we'll reduce from the profit. So therefore less interest on investment already credited. So I'm removing this. Why? Because we are looking at the cash flow from operating activity. So therefore this, since it is not an operating activity, we will not have to consider this. Now do the math. Let me just bring up the calculus so that I can calculate all this quickly. 1835 plus 108 plus 50 plus 550 minus 25, is it? Yeah. So this comes to 25 lakhs and 18,000. Okay, this is the net profit before the working capital changes are brought in. So now what is that we need to identify? Let's see if there is any item which will affect our working capital. So there are two items which we have not yet considered. One is the income tax paid and the other is interim dividend paid. Interim dividend paid is a day-to-day expenditure because it is part of the business, so therefore we won't consider that. But whereas income tax paid, first of all we would have shown it as a liability, and now we have made that payment, so therefore we will reduce that since it is already paid for. Income tax paid, so how much is that? 4,80,000. So now when you do the math, you will actually get the cash flow from operations, which will be 2518 minus 480, which is 20 lakhs and 38,000. I hope it is clear. Let's move on to the next one. That was question number 46, which we had kept pending in the previous session. Now that is over 20 lakhs and 38,000. I hope it is there in the answer. Yes, option B is in fact the right answer there. Then moving on to the next question, a theoretical question is there. As I said, there will be lots and lots of theoretical questions. It's in a way, it's actually a blessing in disguise, I would say. Accounting Standards Board was constituted by the Institute of Chartered Accountants of India in the year dash. A very simple, straightforward question. There is nothing much to do here. All that you need to do is know. That's all. If you know, you'll be able to get it. Otherwise, there is nothing. So here the fact is 1977. So what is this ASB? Since we are talking about ASB, let us also try to understand what this ASB is. Of course, it was constituted in 1977. That is the right answer. Now, this Accounting Standard Board is responsible for formulating accounting standards for use by companies in India. And this ASB has issued a number of accounting standards which are mandatory for all companies listed on the stock exchanges in India. So they also publish guidance notes on the application of accounting standards. It's a body of experts who are experts in accounting and finance, members of industry who are related to accounting profession, maybe academicians, maybe industry members. And this ASB will be headed by a chairman who is appointed by ICAI. And they they meet regularly and also discuss and approve various accounting standards, of course. So that is the role of Accounting Standards Board, and that is what they have done. Okay, fine, let's move on. Vishwajit Hajare says thank you. Welcome, Vishwajit. I hope whatever we are doing will be useful for the students. Moving on. Question number 48. Which of the following sections of Companies Act 2013 is required? The language of institute is so horrible. The grammar. Anyway, what can we do? Which of the following section of Companies Act 2013 requires that auditor has to report whether it, in his opinion, the financial statements comply with the accounting standards referred to in section 133 of the Companies Act? Again, a fact-based question. I think in the very first class I mentioned that Companies Act plays a huge role when it comes to CMA subject. So it is better that you understand all these provisions carefully. Again, so if you read the Companies Act, you will know that it is option C which actually mandates this. That is section 143E. 143.3E, which says that auditor's report shall also state whether in his opinion the financial statements actually complies with the accounting standards referred to in section 133, and then it mandates that he give comments if at all there is any material departure therefrom. That means, first of all, you'll have to tell whether it complies with the accounting standards as referred to in section 133. Then, if at all there is any deviations, material departures or material deviations, then comment on that too. That is what 143.3E says. So now what is auditor responsible for? He is responsible for ensuring that the financial statements are prepared in accordance with the accounting standards. The accounting standards are issued by, we just now saw that, ASB of the Institute of Chartered Accountants of India. So ASB does all those things, and this auditor's report should state whether in his in his opinion, whether it is complying with the standards or not. So he will be responsible. So ultimately, we, the stakeholders, rely on the auditor's statement. So therefore, it is important for auditor to comment on this. If at all there is any deviation, he has to make a note of the same so that we get to know and we will take further decision based on his report. So that was a straightforward question, question number 48. Then question number 49. Let's see what exactly we have in store here. Which of the following is not included in the condition satisfied by the small and medium companies with reference to the applicability of accounting standards? Again, a very straightforward question, I would say, because there is nothing much to calculate. All that we have to understand is whether, if you know the provisions, you will be able to answer the question. You'll be able to answer the question. So now they are asking which of the following is not included in the conditions to be satisfied by SMCS with reference to applicability of accounting standards. Company is not a holding company or a subsidiary of a non-SMC. Company is not a bank or a financial institution or insurance company. Company's turnover does not exceed 10 crores in the immediately preceding accounting year. Equity and debt securities of the company are not listed or are not in the process of listing in any stock exchange, whether in India or outside India. Anyway, so now if you have already studied by now, you would know the correct answer. Option C is in fact the correct answer. Why? Because the conditions satisfied by the small and medium companies with reference to applicability of accounting standards are as follows. First of all, a company should not be a holding company or a subsidiary of a non-SMC. You cannot then claim the status of SMC if you are a subsidiary of some other company which is not a subsidiary, which is not a SMC. Then the company should not be a banking or a financial institution or an insurance company. So these two conditions are in fact the conditions which are there. Then the company's turnover should not exceed 250 crores in the immediately preceding accounting year. But in the options they have mentioned 10 crores, which is wrong. So therefore this does not exist. Of course, you can also see, if you look at the provisions related to the applicability, that there is one more condition which is about companies' borrowings, including of course public deposit, should not exceed how much? 50 crores at any time during the immediately preceding accounting year. And of course the last one being the company's equity or debt securities are not listed or are not in the process of getting listed in any of the stock exchanges, whether in India or outside India. That means this condition is also there. So condition A, condition B and condition D are present, whereas condition C is incorrectly mentioned here. It should have been 250 crores, whereas here they have mentioned it as 10 crores, which is incorrect. So therefore option C is the right answer. I hope it makes sense. Let's move on to the next question, which is question number 50. Now, what is this about? Which of the following international accounting standard is related to earnings per share? Again, a very easy, straightforward question. If you notice the pattern here, what I would, at least what I have noticed is, whenever it comes to accounting standards, the questions will be usually straightforward. They won't ask in detail questions with respect to accounting standards. It's all just in the periphery. For example, they will ask section number, maybe they will ask which accounting standard relates to what. For example, in this question 50, what is that they have asked? Earnings per share standard. Which is the earning per share standard in international accounting standards? So the answer is very simple, IAS 13. Okay, so this standard in fact provides guidance on the calculation as well as on the presentation of earnings per share for entities that have publicly traded shares or maybe potential equity instruments. So in fact EPS, we say, is one of the important financial measures that indicates the profitability of a company on a per share basis, and it's most commonly used by investors to assess a company's performance. Suppose you are a potential investor, you would obviously check the EPS of the company, like what is that the existing shareholder is earning. If the EPS is good, then obviously as you shareholder you will be interested, or as an investor you will be interested. Okay, Sonam Kumari says आपके voice clear नहीं है. Okay, what is happening? Okay, there is an error message which I am getting. Okay, I am removing this piece of cloth. I thought it would be too harsh otherwise. At least now I hope it is fine. YouTube is not receiving enough video to maintain smooth streaming. Oh my goodness, what is wrong now? So 1 second guys. The internet connectivity is fine. I wonder what's the problem. What? The problem is not with the mic, but problem is with the streaming. I wonder what exactly is the problem. Okay, you may expect some buffering. Maybe the voice is not clear because of that. I hope at least now the voice is clear now that I removed that thing. But still it says it is not getting streamed properly. Oh my goodness. This is the first time it is happening. I hope there is no issue here. Let's see, I'm trying to refresh. The connection is fine. Just give me a second. Let me test the connection speed. Speed is not an issue. I don't know what exactly is the issue. I have 100 Mbps here. Okay, how is it now? Is it okay, bad, good, what? Any feedback? I wonder what exactly is the problem. Guys, the ones who are live, if you can ping me and let me know if the stream health is good or if it's not buffering, it would be easy for me to continue. I hope it is fine. Assuming that it is fine, I will just continue. If at all it is not fine, obviously at the end, once you finish, once I end the stream, maybe then it will be available for smooth playing. I hope that is the case. Otherwise I'm not able to figure out what exactly is the problem. Anyway, let me just move on, assuming that you are able to watch the video without any interruption or without any problem with respect to streaming. Next, moving on to question number 51. Which of the following institute formerly was established as a registered company under the Companies Act? This again is a very interesting question. So obviously not ICAI nor ICSI. It was the Institute of Cost and Works Accountants of India. Now of course it is known as Institute of Cost Accountants of India, ICAI. There also ICAI. In fact, there was a court battle between Institute of Chartered Accountants of India and Institute of Cost Accountants of India. So finally I think ICAI, that is the Chartered Accountants Institute, won the case. Anyway, the point here is very simple. The Institute of Cost and Works Accountants of India, when it was established as a registered company. So that is how it was established. Later on, of course, it was converted into a statutory body under the Cost and Works Accountants Act 1951. So that is the thing. Whereas ICAI and ICSI, they were both established as statutory bodies under the respective acts of the Parliament. So when they were established, so there was no question of conversion from companies to statutory bodies in that case, but only in case of option C it happened. So otherwise, yeah. So let's move on. You're not receiving. Okay, let me just check. I'm still getting the same error. Let me just open this on my phone and see if it's working or not. What exactly is the problem here? It seems to be fine. Just checking. Let me check if everything is fine. I don't know if even I am receiving the messages from the chat or not. I myself am pinging here. Let's see if I will receive the message. Yeah, seems to be fine to me. If it isn't fine, please do let me know, guys. Okay, moving on. So where were we? Question number 51 done. Okay, let's move to the next question. The Institute of Chartered Accountants of India is the dash professional body of chartered accountants in the world. This is a stupid question because this is a fact-based question and it is such a unimportant fact that I don't know what is it even doing in our question paper. It's a silly question, I would say. Okay, according to the data, it is the second largest. That's all I can say. Okay, so the ICAI is the second largest professional body of chartered accountants in the world. So what? So the first or the largest professional body of chartered accountants is the American Institute of Certified Public Accountants. So how does that make any difference? So it makes no difference, but if at all we are looking at the numbers, so largest is American Institute of Certified Public Accountants, and the second largest is Institute of Chartered Accountants of India, that is ICAI. That's all, nothing else. Next, question number 53. The Association of International Certified Professional Accountants, launched by, again, grammar. Anyway, so in this case, there are 4-5 options. American Association of Public Accountants, American Association of Chartered Public Accountants, then Chartered Institute of Management, that is CMA. So the correct answer is in fact B and C, or in other words option D, because the Association of International Certified Professional Accountants was launched in 2017 by the American Institute of Certified Public Accountants and also the Chartered Institute of Management Accountants, that is CMA. So the association is in fact headquartered in North Carolina, Durham, that is the place, and it has offices in New York City, London and Singapore. So the answer in this case is option D. I hope it makes sense. Moving on. Next, question number 54. Mandatory applicability of Indian accounting standards to all banks, NBFCs and insurance companies is from which date? Again, as I said, dates are important, section numbers are important, years are important, and days are important. I mean, number of days, penalty amounts are important. Those type of questions will be asked. So now in this case, it's again simple, nothing much to explain here. It came into effect on 1st April 2018. In fact, the Reserve Bank of India, which is the regulatory authority for banks, mandated this adoption of Indian accounting standards for scheduled commercial banks. Of course, they did not make it mandatory for the regional rural banks, but it is mandatory for local area banks, small finance banks from 1st April 2018. Okay. In fact, it's not just the banks, even Insurance Regulatory and Development Authority of India, IRDAI, they also made it mandatory for insurance companies to adopt Ind AS from the same date, that is on 1st April 2018. That is the thing. In fact, since they have mentioned NBFCs, let's also discuss about that. For the non-banking finance companies, the applicability of Ind AS was in a phased manner. That means it was not announced in one go. It was based on their net worth. Say for example, large NBFCs, those with net worth of 500 crores or more, they were required to adopt from 1st April 2018, whereas smaller NBFCs had a later date for implementation. So this is the thing. Next, moving on, question number 55. Okay, which of the following Ind AS is related to the consolidated financial statements? Again, a question based on fact. As I said, when it comes to accounting standards, these are the type of questions which the institute usually asks. So now, which accounting standard, Ind AS is related to consolidated financial statement? So the answer in this case is Ind AS 110. That's it. So Ind AS 110 deals with what? Consolidated financial statements. It requires the parent company, that is the holding company, to present consolidated financial statements when it comes to when a company, that is a parent company, controls one or more subsidiaries. And these consolidated financial statements do what? They present the financial position, financial performance, cash flow of group entities as those of a single entity. That means, let's say there is a company A Limited and it has a subsidiary B Limited. So subsidiary means A Limited should hold more than 50%. Let's say 51% is held by A Limited in B Limited. So now there exists a holding and a subsidiary relationship. According to AS 110, they are supposed to combine the finances and present a consolidated financial statements. Now that we are looking at AS 110, let's also look at what the other AS's accounting standards deals. For example, 108, it deals with accounting for interests in joint venture. and also associate companies. Then AS 115 deals with the accounting for construction contracts. This is for joint venture, this is for construction, and AS 7 deals with cash flows. Okay, so that's all with respect to question number 55. Let's move on. Next question, 56. A simplified financial statement that shows how much wealth has been created by a company is called what? This again is a very easy question. If you have already read the syllabus, you will know which one is the right answer. Once again, a simplified financial statement that shows how much wealth has been created by a company is called dash. In fact, what you can do is in the exam, if you just think, if you use common sense also, you will actually be able to identify the answer. The answer in this case is option C, which is value added statement. What is value added statement, by the way? It is nothing but a simplified financial statement that shows how much wealth has been created by a company. How do we calculate this? Very simple. We calculate this by subtracting the cost of goods sold from the company's revenue. So this value added statement is you can say a useful tool for investors and creditors to assess a company's financial performance. So that is what it is. Income statement obviously is not the answer, because income statement is nothing but our profit and loss statement. So it shows our revenue and expenses. That has got nothing to do with how much wealth has been created. And of course, economic value added is also not the right answer, because it takes into account the performance of a company with respect to the cost of capital, like what is the cost of capital and what exactly the return which we are getting. So EV is usually a useful tool for managers to assess the financial performance and to make decisions about the capital allocations. It has got nothing to do with wealth creation. Okay, so that's about question number 56. The right option in this case is option C. Let's move on to the next one. Okay, we are now in part 2. Okay, did I miss any? Oh, sorry, there are a few more questions. Question number 57. The following is not an advantage of double entry system. Okay, let's read the options. It prevents and minimizes frauds. Obviously it does. Since it is double entry, it will obviously prevent and minimize fraud. I won't get into the details. It helps in decision making. Of course, yes, all those reports which are generated courtesy double entry will help in decision making. The trial balance doesn't disclose certain types of errors. Okay, we'll come back to that. It becomes easy for the government to calculate tax. Obviously, yes. Now the only thing which is left is the trial balance doesn't disclose certain types of errors. Of course, yes, this is in fact the right answer. Why? Because we know what a trial balance is. Trial balance is nothing but a list of all the accounts in a double entry booking system with the ledger balances. Maybe you will have debit balance or credit balance for every account. Now, why do we need trial balance? Trial balance is generally used to verify the arithmetical accuracy. However, it does not disclose certain types of errors, such as maybe error of omission or even error of commission in certain cases where there are compensating errors. In such a circumstance, it will not disclose at all. So therefore, this is definitely not an advantage of double entry system. So therefore, option C in this case is the right answer. Next, question number 58. As per Companies Act 2013, the prescribed form of balance sheet of a company is given in very easy Schedule 3. I don't even have to discuss this. So Schedule 3 has in fact mainly two parts. Part 1 deals with what balance sheet format and profit and loss account or statement of profit and loss, and part 2 of the Schedule 3 deals with the consolidated financial statements and etc etc. So that is what it is. So therefore, part 1 of Schedule 3 is in fact the right answer. Okay, moving on. So here they have also given part 1, part 2. So this can be confusing in the exam. So please make sure that you read all these things in detail, because these are all purely based on facts and nothing else. Moving on to the next one, question number 59. The Corporate Social Responsibility Committee shall consist of dash directors, out of which at least dash director or directors shall be independent directors. Okay. So again, this is also based on facts. Okay. So this is as per section 135(5), and the answer in this case is shall consist of 4 or more directors, out of which at least 2 directors shall be independent directors. So now, who is an independent director? An independent director is one who is not an employee or even the promoter of a company, and who has nothing to do with any of the promoters or directors of the company. So, and these independent directors are also appointed by the board of directors to say provide an outside view or independent oversight and maybe protect the interest of the shareholders. And this CSR committee is an important part of the, what is that called, corporate governance framework of any company. It helps to ensure that the company's CSR activities are in fact aligned with its overall business strategy, and they're also in charge of implementing it in a transparent and an accountable manner. That is what they do. Okay, so that was about question 59. Let's move on to the next one. Question number 60, again a theory question. How many such theory questions? Financial Reporting Council is an organization, okay, of which country? UK. That's all, nothing much. Financial Reporting Council, I think it comes in that last couple of chapters in CMA. If you look at the international accounting bodies, there you can see the details. Nothing much is there, but all that we know is it is from UK. That's all. Next. No. Where were we? Yeah. Question number 61. Okay. Companies. Okay, now we are in part 2, the management accounting part. The company's cost records and audit rules 2014 came into force. Again, this is also based on what is that facts, and there is nothing much here. Everything is 2014. What am I doing here? Accidentally touching this thing, so it is simply moving. Give me a second, guys. So now in this case, which is the right answer, it came into force on 30th June 2014. So that is the right answer. There is nothing much to do here or explain. So what are these rules about? These rules were basically introduced to prescribe the maintenance of cost records and conducting the cost audit for certain companies in India. So they specify, that is the rules specify the applicability, the requirements and the procedures related to cost records, and also cost audit for companies engaged in say specific industries or meeting certain thresholds. So that came into effect in 30th June 2014. That's it. Moving on. Which of the following form is used for filing cost audit report with central government? Again, if you know, you know, otherwise you don't know. So in this case, it is form CRA4, which is prescribed by the company's cost records and audit rules 2014. It is in fact used by the companies to submit their cost audit reports to MCA ROC within the specified time frame. It includes say details of company, maybe the cost audit period, cost auditor's report, and if there is any other relevant information related to cost audit and compliance, so that will also be included in the report, and that report will be submitted in which form? CRA4. That's it. Moving on. Which of the following steps are required for budgetary control? Okay. Organization for budgeting, budget manual, responsibility for budgeting, and budget procedure. Sorry, budget standard. Okay, very little difference is there between all this. Organization for budgeting is in fact common in option A, B and D. Okay. Budget manual is there in option A and B. Responsibility for budgeting is there in both the cases. Budget standard is there, budget procedure is there. See, now in this case, budget procedure is very important, so we'll have to choose option B here. Okay, see, for any budgetary control, the following steps are usually required. One is organization for budgeting. This usually involves establishing a framework within which the organization for the budgeting process starts. It includes designating individuals or departments which are responsible for budgeting and setting up a structure to coordinate the budgeting activity. So that is the first thing which you need to do. Then comes the budget manual. So now what is this budget manual? You can say it is a document that outlines the procedures, guidelines, instructions for preparing the and also administering the budget. It kind of provides a standardized approach for budgeting across the organization. That is one thing. Then we have the responsibility for budgeting. So this is about assigning the responsibility to maybe different individuals or departments for preparing, monitoring, controlling specific assets of the budget. So here what we do is we give them clear roles and responsibilities so that accountability is ensured and also effective budget management is done. And lastly, we have budget procedure. So this budget procedure is nothing but something which defines the step-by-step process, say for creating, reviewing, approving and implementing the budget. It also includes the timelines, the communication channels and the involvement of relevant stakeholders in the budgeting process. So that is what it does. So therefore in this case, option B, which has detailed all the steps for a budgetary control, is the right answer. I know this can be difficult in the exam, but again it depends on how much revision you have done. If you have done enough revision, this should be easy to answer. Okay, let's move on to the next one. 64. A factor which will limit the activities of an undertaking and which is taken into account in preparation of budgets is termed as, again this is also based on budget chapter. In fact, let me just open that material itself, study material. I think I'd open here. I just had search for that also. Here you can see, if you clearly read this, determination of key factor. Key factor is that factor the extent of whose influence must be assessed in order to ensure that functional budgets are reasonably capable of fulfillment. It is also termed as what? Limiting factor and governing factor. So that is exactly what is asked here. Limiting factor, governing factor, key factor. So that means the answer to this question is, which is a factor which will limit the activities of an undertaking and which is taken into account in preparing budget, is all of the above, because it's all one and the same. Limiting factor equals to governing factor equals to key factor. So therefore the answer is all of the above. Moving on. Which of the following is or are purposes of time recording? Okay. Time recording is used for timekeeping and time booking. Okay. See, this time recording is nothing but the process of recording the working time of employees in any organization. It is used for timekeeping and time booking. Now, what is this timekeeping? It is a process of recording the actual hours worked by employees. So this information is then used to calculate the payroll, maybe track employee attendance and also monitor compliance with labor laws. And time booking is the process of allocating employee hours to specific projects or tasks. And this information is generally used to track the project progress, calculate the project costs and bill the clients. So that is what it is. So therefore the right answer in this case would be option D. Next. Oh my goodness, finally we have a practical question. Thank goodness. Question number 66. If the capacity ratio and efficiency ratio of a factory are 95% and 125% respectively, then the activity ratio will be dash. Easy actually, but let's do this. Question number 66. Here they have asked the activity ratio. Activity ratio we know is nothing but what? Capacity ratio multiplied by efficiency ratio. Okay, so in activity ratio is nothing but capacity ratio into efficiency ratio. So now efficiency ratio as well as capacity ratio is given. So if that is given, this is easy to identify. For example, capacity ratio is 95% and efficiency ratio is 125%. That's all. So multiply one by another, you will get the answer. 95 into 125%, so you will get 118.75% as the answer, which is the activity ratio of this company. So that means what? The factory is using its capacity efficiently and it is producing 118.75% of what it could be producing. That means it is more than sufficiently efficient. Okay, so do we have this as an option? Obviously it should be there. Option C is in fact the right answer. Let's move on. Okay, question number 67. What do we have here? Thankfully, another practical question. Let's see. Following information estimated for the year 2021. Normal loss in production will be 5% of input. Sales in units as per sales budget is 38,350. Closing stock will be 600 units, which has been estimated at so much more than the previous year quantity. Okay, input for the production will be how much is what they have asked. Sales is given, so let me write down what is given first, so that it will be easy for us to identify how much is the input which is required. Because we do not know the production input, so that is what they have asked. How much input do we have to pitch in? Because normal loss is given, sales is given, closing stock is also given. Okay, opening stock is also kind of given, only not directly mentioned but still mentioned. So now let me write down whatever is mentioned directly. Sales in units, how much? 38,350. Okay, then to sales, what do? We usually add closing stock. Think of a trading account basically. So closing stock, how much is the closing stock? Will be 6,600 units. Okay, which has been estimated to be 10% more than the previous year's quantity. Okay, if let me do the calculation somewhere else. If previous year's was 100, that is the opening stock. Previous year's closing, this is opening, no, plus 10 raise would be the closing stock of this year. If 110 is the closing stock of this year, 100 would be the opening stock. If 6,600 is the opening closing stock, how much would be the opening? Simple cross multiplication will give us the answer. So that will be 6,600 into 100 divided by 110, which is 6,000. So minus opening stock 6,000 is also given. So now when you do this, you will get the production units. How much did we produce? Which will be 38,350 plus 600, which will be 38,950. I hope it makes sense. So now this is what they have. Actually, we can't consider production units as input because there is something else which they have mentioned. No, normal loss in production will be 5% of input. So production unit is not what we have actually what which can be considered as input, because there is some loss also which has to be taken into consideration. So if 38,950 is after loss, how much would be before loss? For example, let me just do it here itself. Let me erase this now that we are done with that calculation. Input for production, let's assume it's X because we do not know how much it is, minus normal loss. This we know how much? 5% of X, 0.05 X. When you do that, how much is this? 0.95, no, 0.95 X. So this will be the production unit. Now we know that production unit is 38,950. So 0.95 X equals 38,950. So therefore X equals 38,950 by 0.95. Okay, so let me do the math. 38,950 by 0.95, which is 41,000. That's all. So do we have the option? Yeah, 41,000 is in fact the input here. I hope it makes sense. If you have any doubts, please do ask. Moving on. I hope this one is also a practical question. Yeah, thankfully. Next, question number 68. PUVI Limited provides the following information for the quarter ending 31st March 2020. Expected sales of Jan, Feb and March is given. Okay, roughly 40% of the sales are for cash and 80% of the credit sales are collected in the month following the month of sales, and the balance of credit sales 1 month after that. Slightly confusing, the wording, but if you read carefully, slowly, you will get to know what exactly they are intending to say. The amount collected from debtors in the month of March 2020 will be dash. Okay, straightforward question. This is also related to what cash flow, no, or budget, whatever. So now what we have to identify is how much cash we are collecting. So let me write down what is what. First of all, given sales. Here one thing which we have to understand is roughly 40% of the sales are for cash. That means whatever you sell, 40% you will collect then only. 80% of the credit sales, remaining 60, but out of that 60, 80% are collected in the month following the month of sales. That means if you sell in Jan, you will collect in Feb. If you sell in Feb, you will collect in March. And the balance of credit sales 1 month after that. That means remaining 20% after 2 months of the date of sale. So that is what we have to remember. Now first of all, let me write down the sales here. Jan, Feb and March, because we need to understand how much is the amount which we have collected in the month of March. So according to the data, it is 25 lakhs, 28 lakhs and 30 lakhs. But this will not be the amount which we have collected. Okay. So now let me write down the credit and cash sale. So how much is the 40% of the sales are for cash. So 25 into 40%, 25 into 60%. Let me write down 60-40 here. 25 into 60% will be 15. So this will be 10. 28 into 60% will be 16.8 minus 28 will be 11.2. So this will be 18, 12. So this is how it is: cash sales, credit sales. Now cash sales we don't have to worry because we would have collected in that month itself. But credit sales is a cause of concern because we do not know when exactly. I mean, we know, but we have not yet calculated it. We'll calculate now. So in this case, collection of credit sales. Okay. So Jan's credit sale, that too a percentage of Jan's credit sale. If you read the question carefully, 80% of the credit sales are collected in the month following the month of sale. That means Jan credit sales is 15. That 15 into 80% will be collected when? In the month of Feb, 12. Remaining out of 15 will be collected when? In the month of March, which will be 3. So that means whatever we have sold in Jan, out of that some portion is still being collected in the month of March. How much? 3. The same thing with Feb sales as well. How much is the total credit sales of Feb? 16.8. So 16.8 into 80% will be collected in the month of March, which is 13.44. Remaining will be collected in the month of April. But we are not bothered about April. We are only worried about how much money is being collected in the month of March. So now all that we need to do is calculate the total of this. 12 plus 3 plus 13.44. So okay, but the question is how much amount collected from debtors? No, so that means only these two. So 16.44 is the answer. 16.44 lakh has been collected from debtors. But if they ask how much cash is collected from the in the month of March, then it will be 16.44 plus 12, because that is the cash which we collected from cash sales. Otherwise, if they ask like the way they have asked here, how much is collected from debtors, then it will be 3 plus 13.44, which is 16.44. That's all. Okay, moving on. Question number 16.9. Again, a theory based question. Dash is a method of budgeting whereby all activities are re-evaluated each time a budget is set. Discrete levels of each activity are valued and a combination is chosen to match funds available. Again, this is a very famous concept which is known as zero-based budgeting, where everything is reset. So this is a budgeting, method of budgeting where all the activities are re-evaluated each time we prepare a budget. Okay, so in zero-based budgeting, what happens? Each activity is justified from scratch as if it were being started for the first time. In fact, this requires managers to carefully consider the various costs and benefit of each activity and to justify why they should even continue to be funded as if it is happening for the first time. Of course, zero-based budgeting will be a time-consuming thing because everything is reset to zero. But at the same time, it can also be an efficient use of resources, because the managers, whoever is setting the budget, they will have to justify why they need this. Of course, it has its own advantages, disadvantages. You can check it out. But the point here is this thing fits which type of budgeting? Zero-based budgeting. Let's move on. Next. Okay, we will solve the questions in this page and then be done with it. The last part of the question paper, I will take it up in the next video. Anyway, moving on. N Limited has net working capital of 119 lakh, total liabilities of 225 lakhs and non-current liabilities of 140 lakh. The current ratio will be, okay, so first of all, let us write down the current ratio formula. Current ratio is nothing but current assets by current liabilities. So that is what is the formula for current ratio. Now, do we have the current assets or current liabilities in this question? No. We do not have neither current assets nor current liabilities. So we'll have to identify. Let's see. N Limited has net working capital of 119 lakhs. Okay, what is this net working capital? It is nothing but current assets minus current liabilities. Okay, so that is 119 lakhs. Now, at the same time, they say total liabilities is 225 lakhs. So they have split the total liabilities into two different things, non-current liability and current liability. Out of this 225, non-current liability, they say in the question itself, is 140 lakh. So how much is remaining? 225 minus 140. So 85 would be the current liability. By default, we have found out this, I mean, by doing this calculation. So now that we know how much is the current liability, we can easily identify X or current assets. So this will be 85 lakhs. So therefore, we can say current assets is nothing but 119 plus 85 lakhs. So this should be, is it 204? Yeah, 204. So current assets is 204. Current liabilities is 85. Now it's easy to find out the ratio. You can do on your own, but let me just do it. Current ratio would be 204 by 85. So how much is this? 204 by 85, 2.4. So do we have that as option? 2.4 is to 1. That's all. So that is in fact the right answer. Very easy, straightforward question, actually, nothing much. I hope these type of questions are asked in the exam, wherein you will be appearing. Anyway, moving on. Again, one more practical question. A company's purchases are 385 lakhs, sales 510 lakhs, closing stock 58 lakhs. If the rate of gross profit is 25% on cost, then stock turnover ratio will be dash. Okay, first of all, we have to identify what exactly is stock turnover ratio. Stock turnover ratio can be easily identified using cost of, let me write in full form, cost of goods sold divided by what is that, average stock. Sometimes I forget the formula, but I can afford to forget. I've already passed. You guys should definitely not forget. I am assuming that you have stuck this formula somewhere so that you can just read or have a look at it every day so that it will be there in your memory. Anyway, so now cost of goods sold is not given, nor have they given the average stock. So now how do we go about this? There is one way, because sales is given, closing stock is given, GB percentage is given. We can in an indirect way we can identify cost of goods sold. Okay, sales minus GP will be cost of goods sold. Okay, now GP percentage is given, but the problem here is GP profit is 25% on cost is what they have given, but we do not have the cost, we only have the sales value here. So imagine 100 is the cost. On 100, if you apply 25% profit, that is on cost, you will get 125 as the selling price. So now this is what we have, but we can easily identify the profit percentage on the selling price also. 25 by 125, which is nothing but 20%. This is a well-known calculation, that's why I'm not getting into the details here. So what we have understood right now is if it is 25% on cost, it will be 20% on sales. So now we know the GP percentage on sales. Earlier that informed us the GP percentage on the cost. So now Let me rewrite the statement again. Sales is how much? 510 lakhs minus GP, which will be 20% of 510. So 51 twos are 102. So remove that. So 510 minus 102 will be 408 lakhs, which is nothing but the cost of goods sold. So one thing we have already identified. There is one more thing which we can do, because opening stock is given. Opening stock is not given, no? But closing stock is given, purchase is given. We can easily identify opening stock now. See, opening plus purchases minus closing is also nothing but cost of goods sold. So how much is the opening stock? We do not know. We'll consider that as X. Purchases given 385 lakhs. 385 minus closing how much? 58 equals cost of goods sold 408. Everything is here. Now just rearrange the deck here, you will get the values. So 385 minus 58 will be 327. X will be 408 minus 327, which will be 81. So what is 81? X, or in other words, opening stock. Now go back to the original formula. Cost of goods sold by average stock is what? Is stock turnover ratio. Now we have the cost of goods sold, but at the same time we also have average stock. So we can easily identify cost of goods sold is 408, no? Yeah, divided by 81 plus 58 by 2. So 81 plus 58 by 2 is 69.5. So 408 by 69.5. So 408 by 69.5 will be 5.87 times. Do we have that as an option? Yeah, 5.87 times. So I hope that was useful. Okay, let's move on. Next. Okay, one more practical problem. Good that at least we have some practical problems at last. Only theory would be not challenging at all as a student. Okay. Kiran PR says, lovely sir, I hope you are referring to the videos quality. Thank you, by the way. 72. Mahi Limited has closing stock 648 lakhs and prepaid expenses 32 lakhs. Total liquid assets were 1,830 lakhs. If the liquid ratio is 1.5:1, then working capital will be prepaid expenses there, closing stock is there, current assets is not there, but still we can identify. Okay. Liquid assets is there, we can easily identify current assets, no? With that we can identify what is required. Okay, let's do this. Question number 72. Now in this case, what is that they have asked? Working capital. We know working capital is nothing but current assets minus current liabilities. Okay, so we have neither. Let's try to identify both. Okay, so now current assets minus closing stock minus prepaid expenses equals liquid assets. Because liquid ratio is given, we need liquid assets to find out the current liabilities, indirect way. So current assets we do not know. X minus closing stock is there 648 minus prepaid is there 32 equals liquid assets of 1,830. I hope it makes sense. Now we can easily identify, no? So X equals 648 plus 32, 680. 1,830 plus 680. Okay, 1,830. So current assets will be 2,510 from the calculation. Liquid assets is nothing but current assets minus closing stock minus prepaid expenses. Since everything is given apart from current assets, we could easily work backwards and find out the current assets. Now with the help of this we can also identify current liabilities, because liquid ratio is given. What is the formula for liquid ratio? It is nothing but liquid assets divided by current liabilities. So how much is the liquid ratio according to the problem? 1.5. So 1.5 equals liquid assets is 1,830 divided by X. So therefore current liabilities equals 1830 divided by 1.5. 1830 divided by 1.5, so which will be 1220. Now we know current liabilities as well as current assets. Easily we can identify working capital. So therefore working capital will be 2510 no minus 2510, so which is 1290 like 1290 lakhs. I hope it is clear. Let's move on. Okay, one more theory question. Question number 73. What is this about? Which of the following is not included in activity ratios? Sales to capital employed, activity, debtors turnover, activity. Proprietary ratio is not an activity ratio, no? Working capital turnover, activity. So now proprietary ratio is in fact not an activity ratio, because activity ratio usually measures how efficiently a company is using its assets to generate revenue. Okay, so proprietary ratio does not measure how efficiently a company is using its assets. It only measures the proportion of a company's assets that are financed by the shareholders' equity. So it is obviously calculated by dividing shareholders' equity by total assets. It has got nothing to do with the actual activity, day-to-day activity. So therefore, it does not come under the activity. Option C is in fact the right answer. Question number 74, again a theory question. Ideal norm preferred by banks for current ratio. Again, completely fact-based. This is the right option. That's all I can say. Okay. So this is the ideal ratio mandated by banks. Again, it may vary depending on banks, size, risk profile, etc. But generally, this is what they prefer as a current ratio. Sorry. So this means what? For every 1 rupee of current liabilities, a bank, they should have the client of the bank should have at least 1.33 rupees of current assets. If you have 1 rupee liability, current liability, you should have 1.33 current assets. That is what banks prefer. Next, question number 75, last question for the day. Let's look at it and wind up. Which of the following set of report is classified according to their contents? Not a very interesting question, but still see. Descriptive reporting, tabular reports, and graphic reports. This is not classified according to the content, but in fact it is classified according to the format here. Okay. Routine reports and special reports, this again is classified based on the frequency. Okay. And graphic presentation, routine reports, and finance reports, this is a mixture in fact. So what is left? Production reports, sales reports, cost reports, finance reports. It is classified according to what is there in the content. For example, production report relates to information on production activities of a company, and sales reports reflect the sales activities, maybe the quantity of goods sold, the value of goods sold, etc. Cost report will tell us the cost of production, cost of sales, maybe cost of administration, etc. And finance report tells us about the financial performance of a company. They may include information related to profits, losses, assets, liabilities, and even cash flows. So therefore option C is in fact the right answer. That's all for today. We'll start from question number 76 in the next session. That will be the last session of CMA question paper solving.